Alright, so now we are approaching the end of the concepts chapter. I want to talk now about inducement and liquidity. I did talk about inducement and actually about liquidity in the chapter 2, the basics. Now I want to talk about inducement and liquidity and what inducement is. You've probably heard of liquidity inducement theory or whatever it's called. It's basically the concept of when price is taking liquidity from a certain point and then you can expect a potential reversal. So the main basically liquidity areas we have are equal lows. So we have equal lows like this, we have equal highs, okay, and then we have trend line, but we don't really like to use this. We also have 4-hour wicks and daily wicks and also 12-hour wicks. So the wicks basically work like this. I like to use them on the 12-hour or just a daily. When we have a wick that's taken out, we can expect a potential reaction only if we have a liquidation wick that it's called. So we're going to talk about that in the next one. But now I want to go over inducement. So the aspect of inducement is basically when price induces liquidity from a certain point. So equal lows, equal highs, we have session highs and lows. So usually we have Frankfurt high and low. The main one we use is Asia session. So Asia high and low. When that gets induced, we can expect a reversal. And then New York not that much. New York usually has the high on the day and they're usually protected. But we also have Frankfurt. The main one, as I said, we're going to use equal lows, equal highs. We're going to use wicks, and then we're going to use the Asia session for that reversal. So inducement is basically once, let's say we want to take an entry. First of all, there's two types of inducement. We have the inducement when there's a potential entry. That's the one that we're interested in right now. And we also have the inducement, the general inducement as a target, so where price can go. When we have, let's say, equal highs here, and we take a buy from, let's say price comes down, we take a buy from this area, then our target is going to be liquidity. So we're going to target and expect this liquidity to be induced. So inducement means price takes out liquidity. It's that simple, it's not complicated. So here if we have equal lows, then inducement is when price takes liquidity and usually gives a nice reaction to go the other way. In this case, if we are targeting liquidity, which is a very good take profit point that we're going to use, we're always going to target liquidity, because the thing about liquidity that people don't understand is the whole market moves based on that. Once you really understand how liquidity works, you understand how the market moves. So yes, we do have market structure, but we also have liquidity points on the 4-hour and daily time frame. So price moves, I like to call them objectives. So price moves from one objective to the other. So let's say the objective for EUR/USD was to come lower, and then once that low has been taken out, the objective has been basically accomplished, and price is heading towards the next objective, which can be a point of liquidity. So that is why we need to identify where liquidity is and expect for price to induce them. That's the first thing. Now, as I said, we mainly use liquidity as an entry point, as a confirmation, actually one of the best confirmation we can have. So let's say price comes into a higher time frame area, starts giving a change of character, a nice V shape, price moves higher, right? This is the higher time frame area. Price gives this, and now you can expect a market to go bullish. Let's say we are coming into New York open, so we want to take a buy. How do we take a buy? First, we need to identify the entry point. So where are we gonna enter the market? Well, first of all, we have, let's say we have a V shape here, right? We have the flip zone in this area, and then we have, let's say, an imbalance here lower. We have, especially when you have an entry like this, when you want to take an entry actually, we always have two entry areas. So we have the aggressive one, which is usually the flip zone or just along the way. And then we have the safe area or the extreme where we can find an imbalance, or we can just select a POI. Doesn't really matter. The one thing that we need to have, however, is liquidity that's taken before hitting our POI. So let's say this is the 5-minute time frame, price slowly going down, right? And then you see this happening. Price is coming into the flip zone, the aggressive entry. Now, usually most traders just enter directly, but notice something: we didn't have liquidity taken before hitting that entry area. So before any entry area, if we want to validate it and if we want to enter based on it, we need to have an inducement. We need to have liquidity being taken. So that can look like this: equal lows being formed just above the POI. So it needs to be a distance that price can basically give a reaction, create liquidity. So we have equal lows here, and then for price to basically come into one candle into the area, spike, and then give something like this this. So we established liquidity before our area. Now our area has been validated for a potential entry area. We take out liquidity, we come into the POI, we give a nice reaction, and then we start looking for confirmation. So if this is the 5 minute, then we look for 1 minute more aggressive, or we even look for the seconds time frame. So we look for the 1 minute confirmation, a charge, a quick entry, and we just enter covering the low to target high. Because liquidity has been taken, there's a big chance price will react and then either continue or just give us a chance to go break even. However, if price does just come directly here, right, then there is no liquidity being taken, so price has smaller chance of reacting. So what usually happens is price gives a nice reaction, people start going in the trade covering the low, and then they get induced, price comes into the extreme and then just flies. A case and a setup that happens a lot of times. Why? Because we didn't have liquidity before. And what did we do? We created a fake trap, right? We created a fake smart money trap, as I like to call it, because price came here, gave a confirmation. Let's say he gave a 1 minute change of character, and then price didn't hold. It came to take out the low, and then it went into profit. And this is where a lot of smart money traders, they go wrong. But they do not notice that before this area, there was no liquidity being taken. So now liquidity has been formed inside the first entry area. So that can be also, as I said, either equal lows, or what usually happens in this case, price creates a fake SMC trap, a fake smart money concept trap. So that means price comes here and then gives a 1 minute charge, a confirmation, people enter the trade, smart money traders, they enter the trade, covering the low, price gives a small reaction and then drops, and then comes back up and then continues. So exactly what I showed you here, this is what happens on the 1 minute. It's a fake charge, that's what it's called. It's a fake change of character. It's a fake smart money trap, basically. It traps the smart money traders, wicks them out, they are liquidity, and then price moves on. So this right here will save you a lot of stop losses. You'll see, I always look for liquidity to be taken before entering a trade. It's just way safer and you have more confirmation. Now, the other type of inducement that we have, as I told you, is when we have those daily lows or 12-hour lows. So for that to happen, let's say we have old 12-hour candle with a wick down, and then price starts going later in the future, right? Starts going down, almost to that wick. So we mark the wick, and what we want to see for a potential reversal is price wick, take the wick out. So this is called a liquidation wick, takes the wick out and then closes above. So that would just leave a big wick to the downside, but just took out that low. That can be a daily or a 12-hour week. I usually use the daily, but we can go on the 12-hour because basically there's double the week, so we can see it better and have better reversals. Once we see that, this is called a liquidation week on the 12-hour daily. I like to look inside this area for a 1 hour setup. So that means I want to see a 1 hour structure break. So if price is coming down, we have this, and then I want to see a break of structure on the 1 hour here, and then I start looking at the 5 minute or the 15 minute. So I start looking again at two areas, the flip zone, same exact thing on all the time frame. Flip zone and extreme zone or imbalance or whatever it's made there. Then I wait for 5 minute confirmation in that area. So that means again, we go down the time frame, price comes in on the 5 minute, has a charge, and then I look at the entry. And again, we need to see liquidity being formed. So 1 hour does this, then I look at the 5 minute when price is coming into this area. I need to see either a fake charge, and then I can look at the entry here, or I just need to see liquidity being formed before having that charge, and I can re-enter on the retest, cover the low, and go to the moon. So it's that easy, guys. Liquidity is easy, inducement is easy, it's nothing hard, it's nothing complicated. People tend to overcomplicate it just to make it sound better, make it look better, sell it better, right? You saw probably a lot of liquidity based traders, but liquidity is just that. Now, one of my favorite setups for London session is Asia high or low inducement. And that means I wait for either the Asia low or Asia high to be taken before looking for an entry. So perfect example here. You see Asia session being formed, Asia low being taken, price goes to the upside and then goes down again. Asia session, price takes out Asia high. This is a textbook setup. Why? Because you have a bearish, so you have a bearish trend. You can even use the optimal trading range. So you can mark the high here towards the low. All right. You have the higher time frame narrative going bearish. So you have that power, the bearish power. You have a low being set, retracement, Asia session being formed. You create liquidity here, equal lows plus Asia low. And then what happens? Price Frankfurt open, you see Frankfurt open comes up into the area, just stays there, and then this is the perfect setup. So when Frankfurt takes out the Asia high and then London comes in and takes the Frankfurt high, this is the best, just the best setup. When London Open just wicks out the Frankfurt high, it's a setup that works 9 out of 10 times, and then you just enter. I usually just enter when it wicks above Frankfurt high, and I place either a 10 pip stop loss or something around there, and then I reduce it once we see the reaction. So once you see the reaction price just drops, you can just reduce the stop loss. But let's say you go for a 10 pip or 5, 6 pip, something like that, 7 pip stop loss, and I target, because it's a London session trade, I usually target the next liquidity point, which is this Asia low. So I target the Asia low, and then price drop there, gives a nice reaction, and then continues down. So this is one of the best setups that you can have. Also here you see bearish again, London session, Frankfurt comes in, London takes out Frankfurt high and Asia high, and I just, after confirmation on the lower time frame, I just execute the trade and target the next liquidity point, which is Asia low taken, and then price reverses up again. So liquidity is just very, very good. You see here another very good, the same setup like I told you, right? Frankfurt takes out Asia high, London comes in, takes Frankfurt high, and usually just takes it out by a few pips, literally just a few pips. It takes it out because it just wants to set the high. And here, because we also have this New York high, so compared to Frankfurt or Asia or London highs and lows, New York highs and lows tend to be respected, so they can be used as a potential stop loss or a reaction point. So if I want to enter here based on the reaction, I just want to cover the New York high because I know it's going to be probably respected, and then next liquidity point, Asia low, where I can take profit, partials if this is a pro trend trade, and then just try the wave further or just close fully. Here, same setup, Frankfurt takes out the high, London takes the high later in the session, gives a nice reaction to the downside, price comes back again, you can re-enter here, perfect trade targeting Asia low. So Asia highs and lows are one of the best target liquidity points for an intraday move, because usually when the high is being taken out, then the next target is the low. When the low is taken out, then price moves towards the high, and so on. So this is what I like to trade. Also, price usually tends to give a reaction from Asia midline as well. So if you take the trade from, let's say, the Asia high inducement, then you can expect a small reaction at Asia midline. It's just how price reacts. So that can also happen. Just keep that in mind. And then we're going to have the 12-hour and daily wicks that we're going to use in order to spot a potential reversal. So let's see. Usually we like to look at previous 12-hour lows. So here, and also the low that either the previous day's low, which works nice, or just a low that you find nearby. So let's look for a nice example on the 12-hour. On the Forex market, it's usually tough to understand, but here you see the previous 12-hour candle, price below, closed bullish, gave 1 hour confirmation, then price moved to the upside. Here also you had the high here, price wicked above, closed below, gave 1 hour confirmation here, 5 minutes to target the lows, right, and so on. Here also you see take out the previous candle, 12-hour, close bearish, price dropped, and so on. Here also you took out highs, close below, price dropped. Here also you see the 12-hour high taken out, price dropped. And now here also we took out this 12-hour low. We also took a big wick here. When you see a big wick here, that produces a reversal. Price took liquidity, closed here, and then price moved up. That's a good wick that you can take into consideration. And then price wicked below it, and now we can potentially have a pullback. So don't worry, I know it's very hard to spot them at first, but this is why the mentorship also offers my daily outlook. So we're also gonna go on weekly Zoom and just enjoy the process. Hard to understand, but once you understand the concepts, then it's just patience, and you're gonna start spotting everything that I spot, and it's just gonna become a way easier process.